slowing down.
Welcome to Blueprint. I am A.F. Thornton on this beautiful Tuesday afternoon, October 18th, 2022. And we're asking the question this morning, yes, indeed, that freight train just about ran everybody over the cliff. But now that it's back on the track and it's moving the other direction, we've got everybody chasing it. And the question is why, and how did they miss this low, and why in the heck did they short at the low? And we're going to explore those questions here and conclude with a little bit of a direction. In other words, where is the next or the first station to get off this train now that it's back and moving north? So let's start with the graph that's in front of you, or the chart that's in front of you. And I say here, it starts with the Navigator. The Navigator is our proprietary algorithm. It's got 35 years of experience built into it. And that algorithm said buy at 3,600 on Thursday. And to the extent you wanted to scale in, you got a rare opportunity to scale in on Friday. Now, to do that, you have to give up your weekend in a sense, because you know what? It's scary to invest at those kind of bottoms. But I'll tell you a million times, if a trade feels good, it's probably not a good trade. You know, we used to call it the puke point. We were at the puke point, and you could just see everybody's predicting a crash and this and that. And it's, and you know, I'm human. I saw that all over the weekend. And I'm like, God, I hope to hell I did the right thing. Because in addition to losing money, I've got my ego out on the line, issuing a buy signal when everybody thinks it's crazy. And of course, the volatility's been crazy. And we'll talk about that here in a minute. So the Navigator says to buy, we buy. It was giving us a lot of preliminary warning that a buy was coming. And that little C stands for coiled. This thing is coiled and ready to go. So, but there was a couple of other things too that could help you. And I'll highlight one. You've got this momentum divergence on the low down here that you can see. And let's jump to a couple of other screens, because I think there's some other hints here. One of the things I talked about in the blog last week and Sunday night was the 200-week moving average. We were bouncing at that level, or we were at the level. Who knows if we bounce or not. But the probabilities were that we would, because that line has supported every major correction, or even what we call a cyclical bear market, going back many, many years. I mean, it's almost, you have almost an 8 out of 10 probability, 70, 80% that you're going to bounce on that line, even if it turns out to be a more significant bear market. The other thing we know is that the few times that that line gets violated is when we're actually in a full-blown recession. We saw that in 08, 09. We saw that in 2000. We also saw it, you know, a little bit of a violation back here, but primarily back here in the 70s, which is a time period very similar to what we're experiencing. So there were just a lot of reasons to believe. We're not in a full-blown recession yet. We're on our way. I mean, President Orwell has definitely done a good job of ruining the economy, but I don't think that's going to manifest for a little while. We're probably going to have positive growth in the third quarter because, as we all know, wars are good for business, right? So don't think that's an accident. So anyway, we're going to have positive growth, and probably the deeper or more significant recession is still out in front of us. So for now, this looked like a pretty low risk to stop entry point. And that's what it's all about. How much money do I have to lose to find out? I don't want to wait till it's all the way back up and everybody's confirmed. I mean, if I'm going to lose money, I'd rather minimize it. So I always look for that low risk to stop entry point. A final area that certainly was helpful to the cause of buying that low was investor sentiment. There's all kinds of different ways to measure it. We measured many different ways, but I thought the one that really stood out this time is the put call ratio. This is where we measure how many retail traders are buying puts versus calls. It's a ratio. And when this ratio is high, that means retail traders are shorting usually close to the low of the market. They're betting that the market's going to go down. Instead of at the peak, they wait till it's at the low. It just is what it is, right? So we saw, now again, the option market has grown, and that's certainly a factor here, but we saw the highest put call ratio in history on last Thursday and Friday. And it just, you got to look at the fact that this ratio was down here on Wednesday, and this is what it did through Friday. So you've got all these people, and I'm sure there's some institutions in there, literally buying puts, shorting the market at the lows, right? And when we've seen that in the past, it has typically brought us at least an interim or intermediate low, and that was certainly influencing me on Thursday and Friday. So far so good. It's worked out. I'm very happy with that. But now that we're back on the train and the train's back on the tracks, where's the first stop? Where's the first station? And where should we get off? And let's move to another chart here, which is going to give us some hints on that. And this is just a 2-hour chart using 24-hour data, the S&P continuous futures chart. And what you'll see here is I put a little X on the target. If we do a seed wave measurement, which is what I call projecting this loop higher, the first projection is at about 35.17, which is coincidentally also this high out to our left. And we have some other targets if it wants to keep going, but I got a funny feeling this is going to be it for the first run. And the reason why is we see a leading diagonal here, right? That's a rising wedge, leading diagonal. And those tend to point to where they're going to peak. The measured move when we break the diagonal is usually the base of the diagonal. Sometimes it'll just come down to half. But that's not a rip-roaring rally straight up like I'm going to stay in this thing all day type of pattern. And in fact, we see diagonal patterns at the beginning of rallies and at the end of rallies. So likely this is the first wave up of this rally we're in. And, if we look at the past, like say 2008, 2009, from the same point when we bounced on the 200-week moving average, we recovered half the losses at that point in the market. And if we were to do that here, we've still got a ways to go, right? And I could actually see this diagonal topping out here, and then this could likely be a head. This could be a left shoulder, and we may form a right shoulder into the 21st or the 25th, which is what a lot of the moonbeam folks are calling for. The astrological folks are telling us that the reason we're going to crash is because we have the similar conditions that we had in 87 in terms of planet alignments and things. And by the way, I do take those alignments seriously. I'll show you someday just how important they can be. But I think you've got to look at price rules. It's all about the price. But in any event, they'll probably get a partial wish if we top out here as I expect and we go down to retest. And for you Elliott folks, this could be your 1-2, right? We all know 2 waves can retrace a lot of the 1 wave. But for now, this is where I'm getting out, okay? And I'm going to go to cash because it still is a bear market. I'm not taking any chances. I can always get back in. But if we hit this level tomorrow or even on Thursday, I'm stepping to the sidelines. And by the way, the options market is supportive going into expiration on Friday because there's a lot of short-dated puts that are expiring, and that's going to give us some Vanna tailwinds and maybe a little bit of charm. So I think it's giving us a little bit of a positive bias into expiration, monthly expiration Friday, which, lately we've kind of dipped into there. So that's my best judgment of at least why we went in, where we're at, where we want to get out, and what might happen next. And speaking of the options market, you know, you've all seen this extraordinary volatility in here. It's unprecedented. I mean, off that Thursday low, we rallied 5%, and then we had that retracement of, you know, basically half of that, which, you know, if you look at all the short covered rallies that have taken off recently, you never got that chance to get back in. That was a gift. But I think there's an explanation for it right now too, because if you look at the market, a third of the options are dated less than 7 days and some less than a day. There's a huge number every day of 20, you know, options puts that are expiring at the end of the day or a day later. And that's going to lead to a lot of volatility. First of all, we know that liquidity is low in these kind of markets. So that in and of itself will cause the volatility increase. But, you know, look at the difference. If you've got a put, right, think of all these people that were buying puts at the bottom and it's going to expire tomorrow. What choice do you have but to bail, right? I mean, are you going to get your head handed to you? So people are bailing quickly all at once. They don't have a week or a month or whatever it might be to make a decision. So they're you know, they're getting out in bad places. So that's, you know, people selling calls, people buying puts. It's not been a pleasant experience, but it never is when you try to short the market at the bottom, for the life of me. You know, and you can go back and look at my blogs. I just tell people, why in the heck would you short here? What are your probabilities? You want to buy here because you I mean, if you have the other elements in place, but you certainly don't want to short, because if you're shorting, you're betting on a crash. And a crash is a low probability event, is usually, you know, driven by some sort of trigger, some sort of event. And if nothing else, this bear market has been very orderly. And I do have a little bit of suspicion, excuse me, that on the lows, the Fed plunge protection team has been coming in here. They want the market to go down, but they don't want it to crash to the extent they can control anything. So summarizing then, we had great reasons to accept the buy signal that the Navigator algorithm gave us last week. We have a target to get out, and we know why we're getting a lot of volatility. So let's just see how it goes here. Sorry for the hoarse voice, but it's late in the day, and I've been calling out trades in the trading room. Speaking of all that, thank you so much for watching this video. Be sure to leave a like and comment below. Also, subscribe and hit the bell icon so you can be notified of the next video. And I hope you'll join me over at bluequanttrading.com. Not only is there a great blog there every day, you may also want to join us for live trading. We have a lot of fun in the trading room, and it's a great learning experience, and kind of keeps your finger on the pulse of everything that's going on. I hope you've enjoyed the video. Have a great evening, and I'll see you in the next video.